Okay, you guys, now we're going to take a look at exercise 20-23. And here we're just dealing with error correction. And with error correction, we would go back and restate any comparative statements that are being shown, or at least go back and correct the beginning retained earnings balance. So they give us some 3 independent situations and unrelated errors. For each one, they want to know what would be the effect of the error on the income statement and the balance sheet in the 2015 financial statements, and then prepare the journal entries each company should record in 2016 to correct the errors. Okay, on A, on December 31, 2015, Wolf Bach Corporation failed to accrue office supplies expense of $1,800. In January 2016, when it received the bill from the supplier, they made the following entry. Now, if they paid the supplier, the credit to cash is fine. What they did, though, they failed to record $1,800 of expense in 2015 that should have been recorded in 2015. So, on the income statement, okay, by not recording this office supplies expense in 2015, on the 2015 income statement, expenses were understated, specifically office supplies expense, and that caused net income to be overstated. Then, on the 2015 balance sheet, liabilities were understated. We weren't showing that we owed this $1,800 at all to the supply company. And since net income was overstated, retained earnings was overstated. Okay, so there's what happened on the 2015 income statement. Expenses, office supplies expense specifically, was understated, and that caused net income to be overstated. Then on the balance sheet, liabilities were understated. The amount owed to the office supply store was not shown as a liability. And since net income was overstated on the income statement, then retained earnings were also overstated on the balance sheet. So on A, to correct that error in 2016, we're going to debit retained earnings to decrease its balance, you guys, by $1,800. Okay. Now, what about the credit to cash? Well, eventually the supply company got paid and cash would have needed to have been credited. The liability that should have been recorded at the end of 2015 was never recorded, so it wasn't there to go away. So that's the liability would now be gone, the cash would now be gone anyway. So we've decreased retained earnings with a debit by its balance. Then we also need to decrease office supplies expense in 2016. Because what? We recorded $1,800 of expense. It was actually expense for 2015. This debit to retained earnings gets the beginning retained earnings balance correct. It decreases it by $1,800. The amount that expenses were understated and net income was overstated by at the end of the prior year. Okay, on B, let's read it. On the last day of 2015, Midwest Importers received a $90,000 prepayment from a tenant for the 2016 rent of a building. Midwest recorded the receipt as rent revenue. Okay. On the 2015 income statement, revenues were overstated by, let's see, how much was it? $90,000. Or we can just say they're overstated. I guess we know the amount. And net income was overstated so that's how we did the other one. On the 2015 income statement, revenues were overstated and net income was overstated. Okay, then on the 2015 balance sheet, liabilities were understated, specifically unearned rent, and retained earnings was overstated because net income was overstated. Now on B, how do we correct this? Well, retained earnings was overstated by the amount of the error, $90,000, so we would debit retained earnings to decrease its balance. Then we're going to credit rent revenue for $90,000 in 2016, and that gets it on the books in the year it was actually earned in. Okay, C. At the end of 2015, Dinkins Lowry Corporation failed to accrue interest of $8,000 on a note receivable. Okay, so they should have, at the end of 2015, debited interest receivable and credited interest revenue. At the beginning of 2016, when the company received the cash, it was recorded as interest revenue. So, okay, on C, on the 2015 income statement, revenues were understated, specifically interest revenue, and that understatement caused net income to be understated. Then on the 2015 balance sheet, assets, we could say current assets, specifically interest receivable, were understated. And since net income was understated, retained earnings was also understated. Alright, so now how do we correct this on C? Well, retained earnings was understated by $8,000, so it's going to be credited. For the $8,000. Interest revenue was credited in 2016, but that interest was actually earned in 2015, so we need to take that off the book. So the debit is to interest revenue. And the debit to it is for $8,000 as well, of course. Alright, so this exercise, you guys, was an example of the correction of errors, which you've seen some of already in the past. So we looked at how you would handle it if you had a change in accounting principle. Remember, that's retrospectively, if possible. If not, prospectively. Retrospectively meaning you go back and restate prior periods' financial statements if they're being presented. And sometimes that's possible, sometimes it's not. If not, we'll account for it in the current period and going forward. Then with changes in accounting estimates, like depreciation changes, for example, those will be counted for prospectively, meaning in the current period and going forward. And then with errors, we want to go back and change those as far back as we made the error. So they would be accounted for retrospectively. And that's it for Chapter 20. Please be sure and notice you got some new exercises up on the Connect Plus site to work by May the 8th. And good luck, you guys. Thanks.